Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hey, Standard Deviations listeners. Did you know that you could be receiving continuing education credit for listening to certain podcast episodes? That's right. There are continuing education credits available for CFP board advisors, along with CMAs, CPWAs, and RMAs for certain episodes. The Advisor Academy is Orion's free, continuing education platform for advisors where you can get CE credits on the go. The platform offers a handful of podcast episodes that you can either listen to or watch and receive CE credit. Check the podcast description for more details or visit orionadvisorakademy.myabsorb.com and use code PODCASTS, that's podcast with an S, to sign up. Note, not all podcast episodes qualify for CE credit. You must listen or watch through the Orion Advisor Academy to receive the credit. Visit orion.com/advisor-academy to learn more. Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and today I'm joined from across the pond by Dr. Greg Davies, a specialist in applied behavioral finance, decision science, impact investing, and financial well-being. He's a pioneer in the space, having founded the banking world's first behavioral finance team at Barclays in 2006, which he then led for a decade. In 2017, he joined Oxford Risk to lead the development of behavioral decision support software to help people make the best possible financial decisions. He's also the author of a book that I really like called Behavioral Investment Management. Greg, welcome to the show.
Thank you very much. Thank you for having me.
Well, we're long overdue for a catch-up. We almost didn't get this recorded because we were having so much fun doing that, but we got you here to talk about all this behavioral stuff. You really are one of the pioneers. You know, you and I have been having conversations going back many years.
Yep.
And, you know, one of the things that's happened over that time is this work has become greatly popularized. I mean, there's a lot more voices now than there were when you and I were initially having those early conversations. Relative to all the other behavioral experts out there, what's unique about you and your work, and how did you arrive at this unique point of emphasis?
Oh, good question. I think perhaps my original trajectory into it is what made it unique, because I started in finance. There are a lot of behavioral people, not just in financial services, but in various commercial areas, who very much come through a psychology route. And I actually started in a much more tedious, boring world of quantitative finance. But what that meant is I started knowing the traditional theory and the mathematics and the quant of portfolio theory and finance stuff very, very deeply. And for me, the behavioral science bit has always been not how do we throw that out. We know that people aren't fully rational in the narrow economic sense all the time. We can all accept that, but that doesn't mean that you just ball up everything 6-7 decades of finance theory, throw it out so you can be behavioral about everything. For me, it is really about how do you get the best of both worlds. We aspire to build technology that helps people make better financial decisions. Now, if you're going to do that, you have to have a pretty good idea of what you think better is. And that's where I think, you know, traditional finance theory, all the mathematics and the quants and the theory behind that, actually, although it defines the right answer for an entity that doesn't exist, this hyper-rational Homo economicus person, that person doesn't exist, but it still forms the basis of what most of us should aspire to get closer to. So for me, I think the unique bit is constantly trying to weave together and synthesize traditional finance theory together with behavioral finance to get the best of both of those worlds.
Well, interestingly, I feel like the discipline is coming back to perhaps where you started, because I think when I started doing this work, and I was certainly a party to this as well, I don't want to suggest that I wasn't, there was this sort of gleeful poking of holes in traditional economic theory, right?
Yeah.
And it's like, look how stupid this is. And I mean, in my discipline, because I'm a clinical psychologist by background, I think we saw this with Freud too. It was just like, for a season, it became really sort of popular to poo-poo Freud and ridicule everything that he did. Well, then you kind of come full circle and you go, well, yes, he didn't get everything right, but he sure did anticipate a lot. And at a minimum, he gave us a lattice work or a framework to react to. And I don't know that behavioral science has always been very good about that. I think behavioral finance has at times been better about deconstructionism than constructionism. So yeah, any thoughts that sort of us coming full circle?
Well, I think all fields acquire dogma along the way. And, you're constantly battling against people who have their own particular structures and frameworks. And there's constantly a temptation to almost set up a straw man conflict between my way of thinking of the world and other people's ways of thinking of the world. And that leads to a partition and a division. And it's useful when the field is young and you're trying to define your field. To define it in opposition to something is kind of helpful, right? It gives you something to fight against, to battle against. It helps you to get a clearer definition. But ultimately, for all of these things, the answer is somewhere in the middle. And this actually, it relates to a very behavioral concept, which the whole notion of mental accounting, or accounting in general. I tend to think that any form of dividing the world into pots or accounts, or in a business, it'll be business divisions, or in the academic world, it will be subject-based silos. We do these things because when we start to partition a complex problem into pieces, it's much easier for us to think about. And so it's something that we have used the word gleeful earlier. It's something that I think we as humans gleefully take on is, this is my pot over here and that's your pot over there. It just makes the world easier to think about. But of course, the world is messy, and the reality always lies somewhere between those artificial accounts or pots or business divisions, etc.
Well, it's funny, behavioral finance, when I give sort of my colloquial definition of behavioral finance, when I'm asked for it, I say, it's basically money that accounts for the messiness of humankind. But even a field that accounts for messiness is so embedded in messiness, can be prone to the same tribalism and dogmatism and sort of artificial binaries that other forms of thinking. So we need to embrace the messiness, embrace the rough edges and the blurry borders. And I think that's you've done well for a long time. We're just going to do easy math here. Let's say a decade ago, I think it was more than that, but you and I started talking about these things, call it a decade ago. What have been the biggest changes in behavioral finance in that past decade? And then casting your mind forward, to the next 10 years, when we do this again in 10 years, what do you think we'll be talking about then?
Yeah. Last 10 years, so that takes us back to 2014. I actually think that from my perspective, and I will grant this is a particular perspective, because as you say, I'm on the other side of the pond, so there are probably some geographical differences in this. I was also working inside a large bank, so I had a particular viewpoint on this. But about a decade ago, I felt that the applied behavioral finance was going through a little bit of a doldrum period. Coming out of the financial crisis of 2008, 2009, everyone was super focused on, wow, it is all about emotions. It's about understanding decision-making, and behavioral finance, relative to other areas of economics, had a real resurgence post-crisis. And I think that is a general truism of practical focus on behavioral science, is people are drawn to it when the world gets messier. And when the world is nice and tidy, they think, oh, our standard models are fine. We don't need to think about the messiness of human decision-making too much, so we can put it aside. So I felt around 10 years ago, there was a little bit of a doldrum. Interest had waned somewhat in the applied behavioral finance. And part of that was, I think, the earlier promises, which granted were often perhaps a little, over anecdotal. Lots of interesting books written, Nobel Prizes won, etc. There's the big showstop headline capturing stuff was out there, and everyone post financial crisis was very excited about it. And then we realized there's an adoption problem, particularly inside a big bank. I found it doesn't matter how good your behavioral ideas are that you're trying to introduce into the organization, but everyone in that organization is already doing a complex job. And the ideas you're trying to layer on top of their already complex job might be awesome, but you've also just made their lives more difficult. And so I found that there was a massive adoption problem at that point. Most of what we were trying to do was to inject behavioral science into organizations by effectively teaching people about it, by telling them how cool it was, by showing them this is what you can do, but then expecting them to do the hard work, actually building it systematically into their day jobs, etc. And it's one of the reasons that I left Barclays way back, and it's one of the reasons that I joined forces with Oxford Risk, because I came to the conclusion that unless we build these ideas into technology that we can give to people who can just turn on and use it without having to go and educate themselves for several years on behavioral finance ideas, unless we make the adoption bit of it easy, it's not going to scale and it's not going to get used effectively. And so I very much have come to the conclusion that behavioral science intersected with data science, intersected with technology and digital and all the exciting tools of AI and large language models, etc. That's where it's going now. It's never behavioral science on its own. It's behavioral science in conjunction with these other tools that enable it to scale, enable it to be delivered more effectively, and enable people to use it without having to retrain themselves massively.
Yeah, you and I are in massive agreement there. Like, I talk a lot about embedded behavioral finance. It has to operate basically behind the scenes, and it just has to be doing what it does without any real awareness even on the part of the user. I mean, that's kind of one of the hallmarks of technology. Like, we all use our phones and they just kind of are. You don't have to be, my nana can use an iPad. That's why an iPad has sold a zillion, that's why I've sold a zillion iPads. It's like, my kids use an iPad, my grandma uses an iPad, and we can all just kind of do it. I think we have to take the learnings of behavioral science out of that ivory tower, bake them into our processes, because there was a time there, and I think back to the 2010s for a decade. It was all anyone wanted was funny stories, right? Like, tell us quirky, funny stories of human irrationality, and like, aren't people so silly? But then, like, how did any of that get implemented? And we know that education is such a weak predictor of behavior. Even if we're teaching great stories, great principles, and with these funny stories, the research suggests that the amount of that gets implemented in the lives of clients is vanishingly small. So I do think that embedded behavioral finance tech is the future of the whole thing.
Yeah, no, I completely agree there. And it's not to say that people can't absorb those stories themselves and use it themselves, but not everyone is inspired to. You walk out of a seminar room where someone's told you some great stories and you think, oh, that was entertaining, and I'll think about that a bit. But to actually take those and embed it deeply into your way of doing things, the business processes that you use, it takes a lot of work and effort. And most people, even if they have the inclination, simply don't have a lot of spare time floating around the edges of their job in order to, take up the floorboards and relay everything on a behavioral foundation. So absolutely, we have to make it easier for people. And the technological advances that you're seeing, and I'm not a technologist, but we do a lot of data science, and we have people around me who know a lot more about technology than I do. They seem very natural bedfellows, because particularly now, the messiness that we've talked about around behavioral science, it means that individual differences are important. It means that personalization becomes important. It means that there are lots and lots of moving parts to juggle that humans are bad at juggling on their own and coming and putting together in an objective way. But the advances of technology that we're seeing are good at doing all of those things. And so it's almost like the technology has got to the point where it's catching up with the promise that behavioral science had initially, and hopefully will be the mechanism to really make it effective and scale.
So I asked you at the outset, what was sort of the hallmark of what made your work special or unique? If someone were to ask me the same thing about you, I would have said you have deep expertise in risk. And indeed, you work at Oxford Risk. What does behavioral finance have to teach us about risk? And how widely implemented are these learnings in the field today?
I think the most important aspect about risk from a behavioral side is that it is multidimensional, that people differ in their attitudes to risk and their preferences for risk, but they don't differ just along one continuum. It's not like somebody is a higher risk tolerant individual and someone is a low risk tolerance individual, and they will be thus forever immutable, fixed. There are many different sub-dimensions of risk attitudes, which makes the whole thing quite murky. And particularly I've found in the field of financial advice, where people like to reach for a fairly simple model. You want to put people on a continuum, are you low or high? And actually the real behavioral value is understanding how these dimensions split off for each other. And I'll just give one example, because we build at Oxford Risk psychometric tools to measure financial personality on multiple dimensions. One of those dimensions is risk tolerance. It's really the only aspect of personality that classical finance theory has any space for. It says, let me measure your risk tolerance. I'll use that to calibrate a utility function, and then that helps me to pick off the right point on your efficient frontier. And even Homo economicus, even this completely rational economic being, will still have that element of their personality. They will still have a risk tolerance level that governs their willingness in the long term to trade off risk and return. The problem is that if I ask you how much risk you're willing to take this morning in your portfolio, you will give me an answer, but it is very seldom going to be the same answer as your long-term stable risk tolerance level. Because the answer you give me this morning depends on what your portfolio has done yesterday, the conversations you've had with your advisor last week, the conversation you had with your friends about cryptocurrencies at the dinner party table on Saturday night, what the weather is. All of this behavioral context-dependent stuff impinges on my current momentary risk attitude. And so one of the other scales that we measure is composure. It's the degree to which the world impinges on your anxiety levels right now. It's almost a package term for your tendency to a lot of the short-termist biases of that behavioral science will make clear. Now, your risk attitude at any given moment is a blend of these things. It's your composure level combined with the context you're in, combined with your baseline long-term level of risk tolerance. But if I want to build a portfolio for you that you are going to hold for the next 5, 10, 15 years, the answer you give me about the risk level you're prepared to take this morning is the wrong basis for that. To get to that, I need to somehow cleanse it of all of this context, of all of the composure effects, and try to come into something that is a bit more fundamental. So we use psychometric tests to sort of really isolate these things. But the general point is that there are multiple dimensions of personality dimensions of risk, and they lead different people to respond very differently to the same circumstances. At the time we're recording this, the markets have been, shall we say, twitchy this week. And, there are people out there who are naturally high composure people who find it very easy to keep their eye on the long distance horizon. They're not too, they're just, the day-to-day ups and downs just don't affect them that much. They are not emotionally invested in the present as much as people who are lower composure. And that distinction is not inside any formal models of risk in the classical economic theory or the classical finance theory. And yet it makes a fundamental difference to how people respond in their decision-making. So that for me is I suppose, it's not that useful a perspective, because I've just said that the behavioral problem with risk is that it's really messy. And we keep keep coming back to this. But for me, it's about understanding the individual. And to understand the individual, I need to be looking below the headline level of risk tolerance into what are the influencing factors that are driving people away from that in any given moment.
I think we as an industry have a linguistic problem too, because if you ask the average advisor, is someone's risk tolerance static over their lifetime, they would say emphatically no. If you ask the average academic, they would say yes, like within a we're relatively stable. And that's because what most advisors call risk tolerance is sort of this aggregate of capacity, composure, tolerance. How it gets used commonly is not how it's used academically. So, I'm thankful to people like you and others who are kind of helping to spread that gospel. How do you think about the problem of multiple risk preferences within a household? This is something I find can get complicated if a husband and a wife, say, have dramatically different levels of risk-taking behavior. How do you parse that?
Yeah, what we would say to our clients is best practice is, firstly, you're never just measuring risk tolerance, you're measuring people on multiple dimensions. We would take our financial personality assessment tool and we give it independently to each of the decision makers in the household. So you give it to husband and wife separately. You never ever say, go and answer these questions together, because you'll just you lose valuable information. So if I've got his and hers financial personality assessments, firstly, it enables me to then sit down with those two people and identify where are your points of difference. There might be some dimensions that you're very closely aligned on. There are some where you're further apart on. Ultimately, because I think that household wealth needs to be managed as a household. Ultimately, collectively they need to come to some agreement, some compromise on the inputs they're going to use into their financial situation. But they should be doing it open-eyed, knowing where their differences lie, and knowing that they have transparently accepted, that, okay, this might be a bit uncomfortable for me in this direction. It might be a little bit uncomfortable for you in the other direction, but collectively we know they're in the right place. You also very often find in a household that one or other person is simply more interested in this, or the more dominant financial decision maker, etc. That can help if one person just really doesn't care that much, but it only helps until there's a crisis, and then you've got a problem. So I would say there's no silver bullet solution to that problem, but doing things more comprehensively and more transparently and using these psychometric assessments as inputs into a discussion can be very useful.
Yeah, like, what's the Jung quote? It's early, I'm going to mess it up. Like, until you make the unconscious conscious, it will direct your life and you will call it fate, right? Like highlighting those differences and having a conversation about those differences. There really is no shortcut, though. It's like you make the couple aware of those differences. You have a conversation that leads to a compromise that's done with clear eyes, though, and full understanding.
And I should say, because on most of these personality dimensions, it's like almost any biological measure. The extremes are rare. So there's a normal distribution. You tend to have more people around the middle. The extremes do exist, but I have not that often come across couples who are diametrically opposed in any particular dimension of their risk attitudes. It does happen, but it doesn't happen that often.
I'd like to introduce you to me and my wife. We'll have that. Well, I will be.
What are you, Daniel?
We will be patient zero for you on this diametrically opposed risk-taking preferences. One of the, I've got a smart guy and a pioneer in behavioral finance here. One of the arguments that I always hear a lot about in our space is around emotion. There are behavioral experts who have courses and books and things that say emotion is a data point, and I'm going to teach you how to harness your intuition and understand it. And all decisions are emotional, which is, of course, well established and true. And then there's others that sort of lean to the side of, well, the investment decision-making process should be purged of emotion, and you should make it in as deeply analytical in a way that approximates Homo economicus to the degree possible. What's your understanding of the role of emotion in financial decision-making, and where it's useful and where it's not?
So I think we need to distinguish between two sort of categories here. The one is emotion as an outcome. And because most classical finance models go, what every investor should do is they should maximize risk-adjusted returns. And in that model, emotion is left out completely. And the notion that emotional comfort may be a good thing in and of itself is thrown out. And yet you could have two people who go through exactly the same financial journey. They have the same ups and downs along the way. They end up with the same outcomes. They have the same risk-return experience. And yet one of them has been systematically miserable along that journey because they're low composure, anxious at every step along the way, and the other one is happy and comfortable every step along the way. I would argue that the second investor has done better, even though their financial returns are exactly the same. So I think, firstly, you cannot exclude emotion as an outcome from the process, because having an emotionally comfortable life is a good thing in and of itself, completely aside from your financial objectives. And that means it's something that is actually often worth sacrificing a little bit of financial efficiency for. If I can get a marginally less financially efficient portfolio, maybe the risk-return trade-off is, I'm not maximizing my risk-adjusted returns. I'm sacrificing a little, maybe taking a bit less risk or getting a bit less returns or whatever. But I'm getting in exchange a more comfortable journey, then that is a better place for me to be. And so we would often talk about, instead of maximizing risk-adjusted returns, what most investors really want is they want to maximize anxiety-adjusted returns. They want to maximize the returns that they can get relative to the stress, the discomfort, and the anxiety that they as an individual are prepared and able to bear over that journey. So it changes the destination of what you're trying to pursue right from the outset. So that's one point.
I want to pause there for a minute, because your idea of anxiety-adjusted returns is one that I think about a lot. 4 or 5 years ago, we decided to pay off our house, and I actually thought of this idea of anxiety-adjusted returns at the time because it was not spreadsheet optimal, right? I mean, we had a 2.5% mortgage on our house. It just the numbers did not add up. But I have spent 0 minutes worrying about the opportunity cost of that, and have in fact been quite a bit happier, and have been freed up to take greater risk with my remaining money because I knew I wasn't going to live on the street, right? I mean, it's this idea that sort of come what may, I have a roof over my head. And that allows me a degree of comfort that allows me to take risk in other places. So I really, my wife and I talked about this. This will probably cost us some money, and we don't care. And yep. I think sometimes we optimize for mathematical optimal instead of emotional optimal, and we think about emotion as an input and not an outcome. So I think what you've said is very, very powerful.
Yeah, once you accept that emotional comfort is an end to itself, the question is not how do I eliminate my emotions. The question is, how do I assuage, or how do I buy the comfort I need as cheaply and efficiently as possible? Because if people strive for financially optimal and it makes them deeply uncomfortable, that's where they make the really, really big investment mistakes. That's where you end up panicking at the bottom of the market because you've tried to optimize everything to within an inch of its life. And you find that you don't, in fact, have the emotional resilience you thought you were going to have. And that's where you get the really big costly mistakes. So accept that you need emotional comfort, try and figure out how much you need, and then try to look for ways of getting it more cheaply. Now, for you, whether paying off the mortgage was the cheapest way of doing it or the second cheap, but you came to the conclusion that that was a useful trade-off for you to make. And it sounds like you did it in a very open-eyed, transparent way, which most people do not. They reach for these things when it becomes an emotional emergency rather than try to prepare for emotional resilience ahead of time. The other side of your question, which I think perhaps is the one that you were more driving in, is when do we allow our emotions into our decisions almost as predictive variables to go, is my emotion, is my inclination or my gut feel or my intuition leading me astray from what is the sensible investment decision, or is it a useful data point, as you said, to get me closer to a good decision? And I think that one is a tough one. As you said, there's a lot of debate on this. I think there is always a role for intuition and emotion and gut feel. There is a data point there. The thing I would say is most people, not all, allow that intuition more leeway than they should rather than less leeway than they should. So I think there's a role for it, but precisely because it's a gut feel, precisely because it's the thing that deep down feels right, we tend to give it too much rein. So I would say for most people, the better starting point is to try to rely less on intuition than you are inclined to. I wouldn't say ever it's none, but I would say try to find ways of controlling the gut feel and the intuition rather than just allowing it free rein. And there are ways of doing that whilst still allowing it to happen. So, simple things like every decision, or at least every important decision, somewhere in there should be a pause point, a point where you just stop and, I don't know, you walk around the block, you make yourself a cup of coffee, you sleep on it. If it's a huge decision, you write up a 30-page PowerPoint presentation and take it before an investment committee. But at some point in that decision process is a point where you step back and you pause and you take stock. And it's a very simple notion, but I think what it is there to do primarily is to try and give yourself a little bit of space to push the intuition to the side for a moment, and then come back and think a little bit less gut, a little bit of a less gut feel way about it. And if you still at that point go, no, my gut is still telling me to do this, I still think it's important, at least you've given yourself the space. So I would never ever say try to eliminate emotion from your decision processes. I would say try to build decision processes that allow it in a manageable way rather than allow it to dominate.
There's that nuance again, because, the thing I see people doing is saying either relying too heavily on one thing or the other. They'll sell you a course that says, deep down in your heart, you know what you're supposed to do. So I'm going to teach you to harness your intuition. And that's the secret to you being a great day trader or whatever. Yeah. Or you'll see people who say, you should drive emotion from this at every turn, which is of course impossible, right? Like we know from the work of Damasio and others that like it's an inherently an emotional decision, and money is more emotional than most decisions. But I do like this idea of creating systems of processes, and also just knowing that human nature is probably to be a little over reliant on intuition. I'm on a little bit of a health journey this year, and for a while I tried this process called intuitive eating, and I found that my intuition is all wrong, right? My intuition.
I've spent most of my life intuitive eating, and I can tell you it's not got me to where I need to be.
Yeah, I had been intuitive eating all my life, and it had made me quite fat. And, I had to create a process instead. And I think a lot of times, just understanding that we tend to be over-reliant on this and sort of understanding, I think is a great place to start. Well, the last question I want to ask you, I would be missing an opportunity here if I didn't ask a behavioral technologist about the rise of AI. Where do you see this going? I candidly think it's very exciting where some of this is going. Where do you see behavioral science intersecting with AI as we move forward in finance?
I definitely think it's exciting. I think there's a tendency to want to point it at everything. It's a new, shiny new tool in the toolbox, and it's hashtag AI this and hashtag machine learning that. picking the problems, I think, is important. So, for example, I may be proven wrong, who knows, but I'm relatively pessimistic about the use of AI in the sense of replacing an advisor and just using AI to give advice. On one hand, you've got a problem of the black box, right? How do you unpack that afterwards? Can you see where the advice has come from? Secondly, AI, inherently, it's a correlation analysis machine. It's only ever backward looking. It's only looking within the frame of what it historically can view, etc. But most importantly, we don't need it there, right? It's a complicated structure. There's lots of moving parts, but we know pretty well how advice should shift as certain features of someone's personality or balance sheet or plans and goals shift, right? We might not all agree on the best methodology for these things, but for people who've spent time with them, we know how to do it. We don't need AI to tell us how to do that. We just need to have pretty normal, standard deterministic technology to lead us through the decision trees or the processes that gets us to that point. However, I think there's a bunch of places where it can be useful. So what AI is very good at doing, however, is, which humans are not, is monitoring. So you've used a standard suitability process, and I don't know whether that means quite the same thing in the US as the UK, but we would think of suitability as, how do I define whether your solution is suitable for you based on all the inputs that describe you, your risk tolerance, your personality, all of that stuff. Monitoring that dynamically as the world changes is something that we're quite bad at doing. So using AI and technology to do that, I think, is very important. The places that we're using it right now are one of the tools that we are in the process of building is a behavioral engagement technology. And it's not about telling people what is the right answer for their finances. It's about trying to hyper-personalize communication and engagement and delivering. We've been building libraries of nudges, interventions, messages, narratives, and the matching of an individual's characteristics, mostly their personality characteristics, but it could be other things, with messages that are most appropriate for them. That is the sort of task that is very well suited to AI. So very complex message matching and next best action sort of stuff. And then you push that stuff out into the world. And we are very much not in the world of a randomized controlled trial here. You can't go, well, I've done this to 50% of the population and that to 50% of the population, and I'll 3 months later measure what happens. What you get back in terms of have these things worked is a very complex set of data that, yes, this person clicked on that thing, they followed up on that piece of advice, but not this piece of advice. You've got a very, very complicated data set of exactly the sort that AI and machine learning correlation analyses techniques are well suited to pass. And then to go, okay, what do we learn from our attempt to influence behavior with this system of communication or nudges? And based on what we've learned, how do we reparameterize the model for it to be more effective the second time round and the third time round and the fourth time round? So that's an area where we're seeing particularly the machine learning side of AI as being is particularly powerful, is helping us to, in real time, get better and better and better at behaviorally intervening in the decisions that people might be making poorly along that journey. And then, of course, we're using, like everyone, we're dabbling with the use of large language models and ChatGPT to start delivering these messages in individually tailored tones. So you might be wanting to sell two people exactly the same thing, but one person prefers that to be shorter, less technical, more chatty, more visual. One person prefers it to be longer, more florid, etc. We can use large language models to very rapidly personalize the style and tone and delivery of communication in a way that means it's going to resonate more with the people who are receiving it. So I think there's lots of places for it, but I would not say AI is going to replace a financial advisor anytime soon.
Yeah, two important messages there. I think financial advisors, when we look at what AI does well, analytics, rote stuff, monitoring, like you said, what it does poorly, the personal touch, creativity, sales, like there's still a place for advisors. So advisors, take a deep breath. and know that it's probably going to make your life easier and make it easier for you to personalize your messaging. The other thing that I love that you said is that, whenever we get a new hammer, we just start to see nails everywhere. And we've already gotten to silly season a little bit with AI, where we're just solving just solutions chasing problems, and not every problem needs an AI overlord to solve it. So being thoughtful about the problems we're trying to solve, I think, makes a ton of sense.
Just if I could just, because it's perhaps the point I was making about suitability and how to identify the right answer for someone's portfolio, etc. In saying I don't see AI working there, it's not saying I don't think that advisors could not be helped by technology. But this is another distinction I see being quite often blurred, is AI has become such a catchphrase that anytime anyone uses some technology, whether it is genuinely artificial intelligence or not, it gets called AI. And I've seen a lot of people in big banks, saying we use AI, and what they mean is someone once ran a regression model behind the scenes somewhere, and now it's AI. So, I think technology is going to enhance us everywhere, but it doesn't all have to be machine learning, black box, super sophisticated stuff.
Well, Greg, this has been awesome. You are a wealth of information on these topics. If people want to learn more about you and your work, what's the best place for them to find you?
LinkedIn is a good start. So Greg Davies, that's Davies. Push most of our publications out on my LinkedIn feed. And then our company website, Oxford Risk, is just oxfordrisk.com. We have a newsletter you can sign up to for our white papers and blogs, and there's a constant list of published resources out there as well.
Okay, beautiful. Thank you for joining us, Greg.
Thank you, Daniel. It's been great.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.